The news is a weapon used against you. It is constructed to make you act with maximum emotion at the exact moment of minimum advantage. The ticker does not lie, but headlines are designed to do nothing else. They are the siren song that lures the amateur speculator onto the rocks, while the professionals sail away with their cargo of gold. You read about a miraculous earnings report, and you feel the urge to buy. You see a frightening headline, and you feel the panic to sell. Your feelings are a liability, and the news is the instrument used to manipulate them. You are not paid for reading the paper. You are paid for correctly interpreting the tape. The principles for this are timeless. I learned them over a lifetime of winning and losing fortunes, and they were recorded for your benefit in the book, Reminiscences of a Stock Operator. I suggest you study it, not merely read it. You can find a link in the description of this video, but do not think for a moment that a book alone can save you. It can only give you the map. You must still survive the journey. The first step in that survival is understanding the great lie of the news. The stock market is a discounting machine. That is not a metaphor, it is a mechanical fact. It does not react to what is happening now. It reacts to what is likely to happen 6 to 9 months from now. The price of a stock is not a reflection of today's earnings report, but a collective bet on all the earnings reports to come. By the time you read the glorious news in the morning paper, the insiders, the pool operators, and the intelligent speculators have known about it, or something like it, for weeks. They were not buying on the news, they were buying on the quiet accumulation that preceded the news. The run-up in price is the reaction to the coming event. The public announcement is merely the confirmation, and it serves one primary purpose for the professional: to create a market of eager buyers into which he can unload his shares at a handsome profit. The public is buying the climax. The professional is selling it. They are buying a story that has already been told. I will tell you of an instance that taught me this lesson in a way that left scars. There was a stock, Tropical Trading, which had been dormant for ages. Suddenly it came to life. The volume began to swell and the price ticked steadily upward. There were no news reports, no announcements, no apparent reason for the move. The old-timers on the street whispered that a powerful insider group was accumulating the stock. I watched the tape, the modern equivalent of which is your real-time price and volume feed, and I saw the signs of intelligent buying. 1,000 shares would appear on the offer, and it would be absorbed without the price flinching. The stock was being taken by a silent, powerful hand. I followed the trail of this unseen operator and bought a line of the stock for myself. It continued to climb day after day in a steady, professional manner. Then the news broke. It was magnificent. The directors of Tropical Trading, after a special meeting, had voted to inaugurate a dividend. It was the first dividend in the company's history. The newspapers screamed the headline. The brokers' offices buzzed with excitement. The public, who wouldn't have touched the stock a month earlier, now saw it as the safest investment in the world. They fell over themselves to buy it. The stock opened the next morning with a great leap in price. The volume was enormous. And what did I do? I sold every share I owned. My broker thought I was mad. "But Jesse," he said, "the dividend, it's a sure thing." I told him to sell. Why? Because I was not trading the dividend, I was trading the market's reaction. I had seen this play before. The insiders did not accumulate hundreds of thousands of shares just to collect a small dividend. They accumulated them to sell at a profit to the public. And what better time to sell than on the announcement of glorious news, when thousands of buyers are clamoring for the stock? That explosive opening, that huge volume, was not the public buying from each other. It was the public buying from the insiders who were finally cashing their chips. The tape told me the story. The price gapped up several points and then it stopped. It churned. It traded furiously, but it made no further progress. That churning was the sound of distribution. It was the sound of a great wave of buying from the public meeting, an even greater unseen wave of selling from the professionals. I sold right there. And sure enough, after the initial excitement wore off, the stock began to sag. The public who bought the news were left holding the bag as the price drifted back down day after day. The insiders were out. I was out. Only the hopeful amateurs remained. This pattern repeats itself in every market cycle, with every stock, in every era. The names change, the technology changes, but the game remains the same because human nature never changes. People want to be told what to do. They seek certainty where none exists. The news provides them with a false sense of security. They read a positive earnings report and think, the company is doing well, so the stock must go up. This is the logic of a child. It is simple, linear, and fatally wrong. The professional speculator's logic is different. He thinks, the company's good earnings were widely anticipated. The stock has already risen 30% in the past 2 months in expectation of this. Now that the news is out, the reason for buying is gone. The sellers will now emerge. The amateur buys the fact. The professional sells the fact because he bought the rumor weeks before. Consider the opposite scenario, which is even more instructive. A stock fails to go down on bearish news. This is an even more powerful signal. It tells you that there is an enormous hidden buying power in that stock, a force so strong that it can absorb all the panic selling the bad news can create. The public reads the headline, a lawsuit, a failed product, a cut in the forecast, and they sell in a panic. But the price, after an initial dip, refuses to go lower. It holds firm. It grinds sideways on heavy volume. What is happening? The weak hands, the emotional traders, are being shaken out. They are selling their shares to a stronger, more patient buyer who believes the bad news is temporary or already priced in. This is the mark of accumulation. This is the moment to watch that stock like a hawk. When the selling pressure from the bad news is finally exhausted, the hidden buyer will have absorbed all the loose stock, and with no more sellers left, the path of least resistance will be upward. I saw this with a railroad stock before a major court decision was to be announced. The consensus was that the ruling would be unfavorable. The stock had been weak for weeks leading up to it. Everyone was bearish. I watched the tape. On the day of the announcement, the news came over the wire. It was just as bad as everyone had feared. The stock opened down several points. The public, seeing their fears confirmed, began to dump their holdings. Brokers were flooded with sell orders, but the stock did not collapse. It traded at that lower level for an hour, absorbing a tremendous amount of selling, and then it began to rally. It closed the day unchanged. The news was terrible, but the stock refused to go down. The tape was telling me that the worst was over. It was telling me that all the potential sellers had already sold. The stock had been through the fire and emerged stronger. I bought it the next day. It was the beginning of a great advance. I did not buy because I disagreed with the news. I bought because I agreed with the tape. The tape had the final say. Your task is to learn how to read this reaction. Forget the headline. The headline is for the public. Your focus must be on the price and volume action in the moments and days after the news is released. Here is the blueprint for turning their weapon against them. First, you must observe the run-up. Before any scheduled news event, like an earnings release, an economic data point, or a government decision, watch the leaders in the affected sector. Is the price quietly climbing on increasing volume? This is anticipation. This is the smart money placing its bets. You can choose to ride along with them, but you must know that you are in the rumor phase of the trade. The risk is higher, but so is the potential reward. Second, you must witness the climax. The news is released. Let us say it is fantastically positive. The stock gaps up at the open. The financial news channels are ecstatic. Your friends are texting you about it. This is the moment of maximum danger. This is when the public, driven by pure FOMO, rushes in to buy at any price. Do not be one of them. Your job now is to be a detached observer, a scientist studying a reaction in a laboratory. Do nothing. Simply watch. Third, and this is the most critical step, you must analyze the tape's verdict. The stock gapped up 5 points. An hour into the trading day, where is it? Did it continue to scream higher on that massive volume, taking out all offers in its path? If so, the news was even better than the insiders anticipated, and a powerful new leg of the trend may be starting. This is rare, but it happens. More often, you will see the other pattern. The stall. The stock opens at its high, churns on gigantic volume, and then begins to sag. It may close the day well off its highs, perhaps even negative. It might form what they call a key reversal, a new high for the move, followed by a close near the low of the day on massive volume. This is an unmistakable signal. It is the footprint of the professional operator distributing his stock to the amateur. He used the good news as cover to get out of his massive position. The public's buying enthusiasm provided him with the liquidity he needed to sell without depressing the price. This analysis provides you with your action. If you were long the stock into the news, this stall is your absolute non-negotiable signal to sell. Take your profits. Do not wait for the stock to tell you twice. Sell while the buyers are still optimistic and plentiful. If you are a nimble speculator, this can even be a signal to initiate a short position. You are betting against the exhausted buyers and with the powerful insiders who are now out of the stock. Your risk is clearly defined. A stop-loss order just above the high of that newsday candle. You are betting that the emotional climax marked the end of the advance. The public bought the top, and you have just sold it to them. This method requires patience and emotional control. It is tempting to get caught up in the excitement of a good story. That is what the news is designed to do. But you must train yourself to be immune to stories. You are not a literary critic, you are a tape reader. The only story that matters is the one told by price and volume. Does the price action confirm the bullish story? Or does the price action contradict it? The market is never wrong. Opinions often are. My opinion, your opinion, the opinion of the smartest analyst on Wall Street, none of it matters. The only thing that pays is the verdict of the tape. I learned this over and over again in the old bucket shops, which were nothing more than gambling houses where you bet against the operator on small price fluctuations. They would run a story over their private wires about some company being in trouble to encourage customers to sell it short, only to have the price mysteriously rally and wipe them out. The news was a tool, a piece of machinery used to separate a client from his money. The modern market is infinitely more complex, but this fundamental truth has not changed. The news feed, the television program, the social media post, they are the modern private wires of the bucket shop. They create the emotional state necessary for the public to buy high and sell low. Think of any major market top in history. What was the news like? It was glorious. The economy was booming, profits were at record highs, and every magazine cover declared a new era of permanent prosperity. The news was perfect, and it was the absolute worst time to buy stocks. Conversely, think of the great market bottoms. The news was horrific. The economy was in recession, companies were going bankrupt, and the headlines were filled with fear and despair. It was the moment of maximum pessimism, and it was the absolute best time to buy stocks. The market does not top on bad news, it tops on good news. It does not bottom on good news, it bottoms on bad news. Therefore, you must reverse your thinking. Train yourself to become skeptical of overwhelmingly positive news after a long advance. Train yourself to become optimistic upon overwhelmingly negative news after a long decline. Do not ask, what is the news? Instead, ask, how is the market reacting to the news? That is the only question that holds any money-making value. The final law is this. The reaction is the only reality. You must treat the news as nothing more than a catalyst that reveals the market's true character. A strong market will absorb bad news and rally. A weak market will collapse on that same news. A strong stock will ignore a negative headline. A weak stock, pumped up on hope and rumor, will stall and reverse on a positive one. Your job is not to predict the news, nor is it to have an opinion on what the news means. Your job is to wait for the news to be released and then, in the clear light of day, to read the impartial verdict of the tape. If the tape contradicts the headline, you must always side with the tape. The headline is designed to sell papers and capture clicks. The tape is designed to do only one thing: tell the truth. Learn its language, and you will no longer be a victim of the news. You will be one of the few who knows how to profit from it.